Nothing stops the train, but that phrase is often misunderstood. When we say nothing stops the train, we are not describing an imminent crash, and we are not describing a perfect economic outcome. What we are describing is a system that keeps moving forward even while imbalances build beneath the surface. Our strategy begins with the mechanism, not the narrative. The mechanism here is fiscal dominance. When government deficits become structurally large, fiscal spending begins to influence growth, inflation, and financial markets more than traditional monetary policy. That does not mean the system collapses tomorrow. It means the system evolves into a long middle phase where deficits stay high, the economy keeps functioning, and pressure slowly accumulates inside the system. This is the gray zone that Lyn Alden describes. On one side is the optimistic story, where deficits are quickly reduced and everything stabilizes. On the other side is the catastrophic story, where the currency collapses next year. Both of those outcomes remain low probability over an investable horizon. The higher probability path is the uncomfortable middle, where the system continues to run but produces uneven consequences. In that environment, inflation becomes more complex than the headline numbers suggest. Over long periods, inflation is essentially the interaction between money supply growth and productivity growth. If money expands faster than productivity, prices tend to rise. If productivity improves, it can offset some of that monetary expansion. The result is not a smooth outcome. Some things become cheaper, while other things become dramatically more expensive. And that uneven distribution creates social and political pressure. This helps explain why fiscal dominance can already be affecting the economy even if we do not see a crisis. Asset prices may rise while living costs increase for many households. Certain sectors thrive while others struggle. Over time, that divergence feeds polarization and distrust in institutions. Another key mechanism discussed in the interview is the global role of the dollar. Because the dollar functions as the world's primary reserve currency, the global system constantly demands dollar liquidity. One way those dollars circulate globally is through structural trade deficits. Dollars leave the United States through imports and then return as investment into U.S. financial assets, such as stocks, bonds, and real estate. This creates a powerful feedback loop. Foreign capital supports asset prices and strengthens the currency. At the same time, the strong currency makes domestic manufacturing less competitive. Over long time horizons, that can shift the structure of the economy towards services and finance while eroding lower margin production sectors. When investors think about the future of this system, they often focus on the moment when it finally breaks. Our strategy focuses instead on sequencing. Systems like this rarely end in one dramatic event. They usually evolve through a series of smaller disruptions that appear, get resolved, and then reappear in different forms. This is where productivity becomes critical. Technological progress can extend the life of a financially imbalanced system by making the economy more efficient. Artificial intelligence is a major candidate for this productivity boost. But it is important to understand both sides of the equation. Artificial intelligence is powerful, but it is not magic. It improves efficiency, reduces friction, and allows workers to produce more output with fewer hours. At the same time, it introduces distribution challenges because the gains are rarely spread evenly across society. In many industries, the biggest change will not be that artificial intelligence replaces workers entirely. Instead, it will amplify the productivity of people who learn how to use it effectively. Workers who combine domain expertise with artificial intelligence tools may produce 2 or 3 times the output they produced before. But the speed of this transformation is constrained by something more physical than software. Artificial intelligence requires enormous computing power, and computing power requires electricity. Energy infrastructure, power grids, and data centers become the real bottleneck for how fast artificial intelligence can scale across the economy. If you find this type of analysis useful, consider subscribing to the channel. The goal here is to translate complex macro systems into mechanisms you can recognize in real time, so you can better understand what is happening beneath the headlines. This is why the artificial intelligence boom may also reshape financial markets. Over the past decade, many technology giants generated enormous profits with relatively low capital investment. Those profits were often returned to shareholders through buybacks. Now the competitive landscape is shifting. Building artificial intelligence systems requires massive capital expenditure in data centers, semiconductors, and energy infrastructure. That means some of the cash flows that previously went to shareholders are now being redirected into physical investment. When capital flows into infrastructure and industrial capacity, the beneficiaries can change. Energy producers, industrial suppliers, logistics companies, and commodity producers may capture more of that investment cycle. This dynamic can produce a market environment where indexes appear stable while leadership quietly rotates underneath the surface. Technology may remain important, but the next decade could reward different parts of the economic ecosystem than the previous one. From a phase perspective, our strategy currently interprets this environment as a pressure phase rather than a collapse phase. Liquidity conditions remain functional, but valuation compression and sector rotation become more common. Markets can move sideways for extended periods while leadership shifts. What matters most is not predicting the exact turning point of the system. What matters is recognizing the signals that show when pressure is increasing or when stability is returning. A brief reminder that this discussion is educational and not financial advice. The central takeaway remains simple. Nothing stops the train does not mean the system is healthy. It means the system can keep moving forward for a long time while imbalances build beneath the surface. For investors and observers, the most important skill is not predicting a dramatic ending. It is learning to recognize the mechanisms that shape each phase of the journey.